Hey, good morning. This is Mayor Valensky with Driving Markets in the studio at the moment in the class, so I'm not driving, but let's kick off. Okay, right. So following on from last week, where the banking crisis fed into Deutsche Bank and also fed into other banks, where the CDS, the credit default swap rate, or the price of it shot up, indicating that the bank could be at risk. I hope you can hear me, that the volume's okay. Okay, so now Deutsche Bank has been in trouble for many years. And now what happens is that because there's a liquidity squeeze, and because now the banks are under the spotlight, this is causing a lot of concern in the banking sector. Remember, the crisis, or the mini crisis, started in the US with the Silvergate Crypto Bank, then Silicon Valley Bank SVB, then Signature closed down by the Treasury, and obviously First Republic and other banks are feeling the brunt. So all the secondary banks within the states are feeling the brunt, not yet led to the primary banks or the tier one banks. However, Deutsche Bank would be, well, actually Credit Suisse was the first tier one bank to be affected, impacted, taken over by UBS. And the next tier one bank that's coming to the spotlight is Deutsche Bank. The one after that that's likely to come into the spotlight is BNP Paribas, which I've stated over and over again, has got problems there, and that will come out as the liquidity issue tightens and becomes more of a concern in financial markets. Now, what's likely to happen is that the central governments or the central banks will not allow the banking system to fail, especially at the tier one level, not even talking about the tier two level. They're already providing in the Fed in the US is already looking to provide a pooled fund of emergency funding to allow secondary banking and other banks to feed into, in order that they'll have enough liquidity to ride out any particular crisis. So if they do feed in the money, and if they do pump in money into the banking system in the US, or let's talk about in Europe, okay, the ECB or the Germans or the French, whatever the case may be, they're going to pour in hundreds of billions of dollars and hundreds of billions of euros, okay? And that's going to impact potentially inflation. I've just mentioned the camera. Okay, thank you very much. That's going to impact on inflation. The question is, what impact it's going to have on inflation? Now, in my opinion, inflation, if they pump in those hundreds of billions to stabilize the banking system again, as they did back in 2008, then that's going to have a major impact on inflation and going to send inflation sky high, because you're introducing liquidity, you're introducing cash flow into the economy, when really what they're trying to do is lower inflation and take money out of the system in order to calm things down and make money less available. We're talking about, quite simple, the money supply. Okay, so they've got a dilemma here. Either they increase money supply, which is to the banks, or they don't increase money supply and they end up with a more aggravated banking crisis. Okay. However, if they don't increase money supply, then they've got to focus on inflation. If they do increase money supply, inflation is going to go out of control, and the central banks then will not know what to do, because as they raise interest rates to fight inflation, that's causing more of a banking crisis. So it's a major dilemma that we have here at the moment. Talking about a couple of things, dollar weakness. There's going to be continuing dollar weakness going forward as long as this banking crisis continues, and as long as the indication from the central banks is they're not going to be aggressive with further rate rises. That's going to dampen down the enthusiasm for the US dollar, and going to have other majors rising against the dollar, like the GBP, which is cable, euro dollar, and obviously dollar yen. So you could have rising majors against the dollar weakening. Gold's an interesting one. Gold's looking to break through the 2000, where gold is a safe haven in this particular crisis. Okay, dollar's not a safe haven, but gold is a safe haven in this particular crisis. And if the crisis deepens or gets more severe, then you will see gold break through the $2,000 level and move up from there as a safe haven. The other safe haven in this is bonds, US Treasuries, UK gilts, German bonds. You'll see the price there rise, and therefore the yield will go down. So the price of US Treasuries has increased dramatically, pushing the yield down to 3.31%. That's quite low, and I think it's the lowest it's been since September. I'm not too sure on that. Maybe I could be corrected. Okay, so the price of bonds is rising because bonds are considered a safe haven. If this crisis gets deeper, then you're going to see bond prices rise even further, and equity markets will eventually come off, even though they look pretty resilient at the moment. This is Mayor Walensky with Driving Markets. Have a good day.